It's a big day in U.S. economic indicators, and it's a big week as well. I'm here with Platt, reporter of FastFT. Eric, we're going to talk today about the GDP numbers for Q2, and we're going to talk about the FOMC statement, all right? GDP first, okay? 4% growth in the second quarter. That's a really good print. Upward revision to the first quarter. All the underlying components I thought looked pretty good, all right? Consumption, investment, no fiscal drag. There was that swing in inventories that always has people a little bit concerned, but even still, it was better than what the market expected. How did the market react? Yeah, I think you had that inventories number kind of play a little role where people were trying to see, is this really sustained strength? But beyond that, you saw Treasury yields rally much higher. The 10-year Treasury jumped 9 basis points or 10 basis points to about 2.56%, so much higher than it started the day. The dollar strengthened against a basket of currencies, notably the euro and the pound. Okay. And equities first rallied a little bit in the day, but then they sold off a bit. But they're kind of back in
earnings season.
Exactly.
Right? There's more going on there.
I think it has much more to do with, one, this is the busiest week of earnings season this quarter. So you have investors kind of weighing how is top line sales growth doing, how is earnings going, just overall.
Sure. Yeah. Let's talk about the Fed now. Okay. Tough to know what to make of this statement, I think. Okay. On the one hand, the Fed did acknowledge that there was progress made both on inflation and on unemployment in the direction of its targets. On the other hand, the statement added this sort of hedgy language that said that there was still significant underutilization of labor market resources. So you have a hawkish component, you have a dovish component. I don't know what to make of it. Did the markets know whether to interpret this as a wash, or did they just not react?
I don't know. I love that phrase, though, the significant underutilization of the labor force. I had 6 notes in my inbox about, the Fed is much more dovish now, and then one from Goldman and a few other banks saying, no, the Fed's turned much more hawkish. Sure. So I don't really know if they know what to make of it. Bonds didn't move. They stayed almost smack dab where they were earlier in the day. The Fed Eurodollar futures were also little change. Investors are thinking first hikes coming March or June of next year.
I guess it depends on what you want to emphasize.
Exactly.
But what's interesting about today also is that you have a GDP report and you have an FOMC statement, and yet there's more important stuff, if anything, happening later in the week. Obviously, we have payrolls on Friday. We're going to get the PCE inflation number for June. We're also tomorrow going to get the employment cost index, right, which is, I think, considered right now at least probably the best measure of wage growth that we have, certainly the most comprehensive, even though it's, they all have flaws, but that might be the best one. All right. With all this still yet to happen, what do you think the market's going to be focusing on the rest of the week?
I think we've become geared to looking at the payrolls number just because it's, every month a stable indicator. Markets are looking for 200,000 person increase in payrolls, which is smack dab what it's been for the first 6 months.
More than that, right? I think 230, something like that.
Yeah, 230, sorry. Yeah. And then you're also going to see, I think, a big focus on personal income and spending numbers. You've had kind of a steady increase in incomes, but you've seen a bobble in spending. And considering that the economy is, so closely tied to spending, consumer spending, I think that's going to be the focus.
Yeah, and what's interesting about today is that despite a GDP report and an FOMC statement, it's later on in the week that all the important stuff is going to happen. You sort of makes you wonder, well, it's too bad the Fed couldn't just delay its meeting by 48 hours. It would have all this extra pertinent information, but that's the way it goes. So anyways, thanks for joining us.
Gladly.
And if you want to see more, just click on the links below. Thanks very much for watching.